Good morning, everyone. Welcome to today's breakfast seminar. And I'm Stephen Mostyn-Williams. I'm going to ask my two colleagues from DebtXplained on the panel here, who, thank God, are going to do the bulk of the talking on this, to quickly introduce themselves.
My name is Tope Adesanya. I'm a legal senior analyst with DebtXplained. I've worked here for the last 18 months.
And I'm Jamie McDougall. I'm one of the senior legal analysts as well, looking at loans and high-yield bonds. And I've been at DebtXplained for about 2 years.
One of the things that is allowing us to give this presentation is our new database, which we call RLT, Representative Loan Terms, which is a database which is created from derived data from loans that we review and report upon. And that allows us to really see the market as it's moving and monitor it. And you will hear references, I suspect, in the course of all of the talks today to RLT and also to Market Maker, our high-yield bond database. And they're the key of the services that we offer.
Now, interestingly, in the last 18 months, I would say 25% of LMA deals have not allowed incremental facilities at all. And of the deals that did allow incremental facilities, 60% had this standard hard cap amounts. So that leaves the 40% doing something else. And you'll see that really what's happening there is TLB is coming in and playing around with this hard cap amount and using ratios instead. So that gives you a bit of context about what's happening in the last 18 months on that.
Jamie, just the stats you're quoting, you're drawing those from the database where all of this is set out.
Yeah, that's
and
right.
And you can identify in that database what sort of deals these are.
That's right. You can choose the type of deal, type of covenant you want to search.
As Jamie has said, and I think as we are well aware in the market, TLBs are beginning to come into the European market. Just this week, we had 2 deals refinancing from European deals into a TLB structure. So as they start to come in, it's good to understand the differences between them and LMA style. And the 3 points following on from what Jamie has said that I would be talking about is financial testing in a TLB, additional indebtedness, and what is called the restricted group in a TLB. So there will be no financial maintenance testing on behalf of the TLB lenders. There will be what is called a springing leverage covenant. This is usually for the benefit of the revolving lenders in the SFA. And it is usually only tested when the RCF exposure has reached a threshold. We usually see between 20 to 30% of the RCF commitment. Once that threshold is breached, then there's a requirement to test. Similar to LMA style deals, you have the ability to incur additional facilities within your SFA. So, and similar to TLB, to an LMA style loan, you would have a hard cap on this number. In TLBs, it would be a hard cap that may be subject to a grower, like maybe a percentage, increased by a percentage of, say, total assets. So you have that hard cap. And in addition, you can incur additional incremental facilities based on a ratio. I'll come to the ratio discussion later. But first of all, you have your incremental facilities, hard cap, plus unlimited amounts as long as you don't breach your threshold. And then you can also incur what is called incremental equivalent debt. It is incremental facilities, but it doesn't have to sit in your SFA. It can be debt outside of your SFA. It can be in form of notes. It can be other loans. But what it does is the basket, your hard cap and your ratio, that's the same test that you apply for the incremental equivalent debt. So it's just all the debt in the structure that can sit pari passu with the SFA lenders. So that's one basket. In addition, TLBs also allow you to incur additional ratio debt. It can be in the form of senior debt, unsecured debt, junior debt, senior secured, senior unsubordinated. And each of these ratio, the ability to incur each of these types of debt is based on a different ratio. So when I come to the ratios, when we're incurring debt that sits pari passu with lenders, you would have a ratio that is typically based on what is called a first lien leverage ratio. So every debt that sits pari with the SFA lenders and most likely would share the collateral of the SFA lenders will be incurred on the basis of what is called a first lien leverage ratio. And that is just every debt that is incurred on a first lien basis in some SFAs, either on your collateral, and in most, by far, the most formulation we see, on all of the assets of the restricted group. So when you hear first lien leverage ratio, you kind of think it sounds the same. It all seems the same and has the same impact. But in truth, depending on how the calculation is made, it can have a different impact in a term loan. So we can have one that looks solely on the collateral of the lenders, which means basically lenders really shouldn't care about any of the assets within the group that does not form part of their collateral and can therefore be provided as security to other lenders, which is a subordination risk for lenders. But the better formulation, obviously, is the one that looks to all of the assets within the group, including that is not part of your collateral, as long as it's secured on a first lien leverage basis. So following on from what Stephen has said, we have the debt that sits pari passu, and then you can incur additional debt based on a ratio that is junior ranking to the lien that applies to the SFA lenders. That would be junior secured debt. That would have a different ratio attached to it. Usually we see the ratio based on what is called secured leverage ratio. That is, it will be based on all of the secured debt of the restricted group. And then you can also have incurred debt on an unsecured basis, in which case most of the formulation is based on a total leverage ratio of the group. But we do see deals that is based on 2 times FCCR or on a cash interest ratio basis.
Which is more like a high yield.
Which is more like a high yield bond. So it tells you that there is a lot of capacity to have leverage in your group. Leverage which may not affect you if you are secured on collateral, as long as you feel that you have enough value in your collateral such that if things go bad, you get repaid. But if things go bad and your collateral pool just is insufficient, there are other people to contend with if they can incur a lot of debt. So, and then the third point, and a difference between LMA-style deals and TLBs, is the concept of the restricted group, which is a concept that is coming in from the high-yield bond market. So as opposed to an LMA-style deal where the whole of the enterprise would be governed by the terms of your SFA and will be restricted by whatever restrictions are in your SFA. In a TLB, you are only looking at a core group within the enterprise. So you have a carved out group who will be bound by the terms of your SFA. Every other person outside of that group, called the unrestricted subsidiaries, are not bound by the terms of your SFA, can borrow as much debt as they want outside of the restrictions of your SFA, and also provide security over their assets. This is significant when you're reviewing a deal and trying to assess. One of the things you have to get comfortable with is understanding how much value is in your group, in the restricted group, as opposed to how much value sits outside. So we encourage investors to look at that when they are making a decision about investing in a loan. Also, another thing that is different in LMA versus TLB is the concept of excluded property. So in a TLB, you have certain assets within the group that are not secured for the benefit of the lenders. And those assets could include maybe real property that sit below a certain FMV value. In some deals, we've seen the value as high as 15 million. So all property, maybe one piece of property at 15 million will be outside of your collateral package, and therefore can be secured for the benefit of other lenders, increasing subordination risk.
I'll just say one thing is that when you're reviewing a TLB, you don't get to see what the security package is. You usually just get a list of the security documents. So you don't really know actually what they've secured and what exclusions they've included in those security documents. So a security assessment just from reading the TLB is quite difficult.
Yeah, it's
Yeah.
also
Not
harder as
possible.
well because a lot of them are cross-border deals.
Yeah.
And if you've got a big US element, there's stuff about actually getting cross guarantees and giving non-foreign controlled subsidiaries can't give charges over 100% of stock and all sorts of nightmarish provisions.
Okay, well, thanks, Sophie, for that.
Yeah.
The other area we thought we'd look at, because it is very starkly different in LMA and TLB, is value leakage, obviously a concern as well for investors. Again, I'm very brief. I'm going to...
Does anyone have any easy questions on a very complicated area, which is this whole area of increased indebtedness, permitted indebtedness, and everything else? And I should also say that although we've tried to give an overview, of course, there's the whole question of the long lists of permitted indebtedness that you also get in TLBs, and various different baskets and ability to reclassify, allow the high yield market in some deals, and actually it does go on. But does anyone have any specific questions? If you could take the mic, thanks very much, introduce yourself, and then we have the question.
Hi, it's Mel Hugh from Musenage. Just on the subordination risk of, I guess, assets that you don't have as your collateral, I would have thought there might be some negative pledge type language that would preempt the giving away of that security without you having to share in it. I don't know how that ties in.
Okay, well, I mean, Mel says, what about a negative pledge? Doesn't that actually stop you charging these unsecured assets, so assets that are not secured to the lender group, to third parties? I wish we had an agreement and we could show you a list of permitted liens, but I'll ask, well, who wants to take that one?
Yeah. So you don't have negative pledge in terms of the way it is in high yield bonds, which would say if you give the asset to someone else, I also have to share in it. That's not the way it works. You're not supposed to give the assets to anyone, but the issue is you have a long list of permitted liens. And in a TLB, similar to what you would have in an LMA loan, you would have a hard cap basket for which you can make permitted liens. But in addition, TLBs also have a ratio-based permitted liens basket, obviously to accommodate the other types of ratio-based indebtedness that you can incur. But obviously, the ability to have permitted liens, those exceptions, is the value leakage area.
Anybody else want to ask a quick question before we race into the next topic, because time is passing rapidly? Okay, let's go.
So yeah, very quickly, a brief summary of value leakage. We're going to look at dividend sub-debt and cash going to acquisitions. So yet again, very simple in an LMA style deal. You have a prohibition on making dividends to equity. You have a complete blanket ban on paying sub-debt, and that is subject to two carve-outs. One of the carve-outs, yet again, is the permitted payments definition. So you go to the definition section of your SFA. Again, it's a list of baskets. And the most important basket is really your second carve-out, and that is your ratio-based permitted payments basket. So when you get to a certain leverage ratio, you can pay out as much dividends as you like, or if you prefer, you can pay out sub-debt. And just to give you a bit of market flavour on all of this, the leverage ratio is usually set between 2 and 3. If we see anything above 3, we get a bit nervous and mention that in our reports. 30% of deals had a no source of funds requirement, so you can get your operational cash going straight up to equity if you meet your leverage. 50% of the deals required you to use only retained excess cash flow. So excess cash flow that didn't go through the sweep and up to the SFA lenders could then be used to go out to your sub-debt and dividends. And that requirement actually dropped in about 15% of deals when leverage went down to an even lower level. And there are obviously conditions which we track in RLT. For example, if you search RLT, you see 50% of deals have a default stop, 50% of deals have an event of default stop, and you'll see other conditions like prohibition for 12 months after closing on making these payments. That was in 50% of deals. So very simple, cash leakage to equity, sub-debt, easily recognisable in an MA deal. Permitted acquisitions, yet again, blanket ban on acquisitions and mergers, apart from your carve-outs. Go to the definition section. And in the definition section, you'll see permitted acquisition criteria, which is just a laundry list of all the things you have to tick and satisfy before you can do your acquisition. Very standard, recognizable categories, though there are variations within each category. Very common to have control requirement, 50.1% plus board control, and you'll have other things later on, like some look forward for 12-month leverage compliance with 10% headroom perhaps. Lots of variations around the leverage compliance condition. And you will see an aggregate cap. About 93% of LMA deals had an aggregate acquisition cap. So, very brief summary. I hope this is all familiar to you guys. I think the most interesting stuff is what's happening in TLB and how this TLB differs from LMA. So I'm going to let Toby speak.
And of course, you'll know from the previous discussion that what they've got in TLB is going to be really simple too.
Exactly.
So, yet again, in TLBs, your value leakage is controlled in 3 different ways. One is your restrictions on equity payments or payments to equity, restrictions on payment on subordinated indebtedness within the structure, and investments generally. So the value leakage is very similar to what you have in a high yield bond. So you have restrictions on payments to equity, you have a separate basket, unlike the way it's lumped together and you only share one basket for payments to equity and payments to debt in a TLB, in an LMA style deal. In a TLB, you have a separate carve-out for making restricted payments to equity. So you would have a hard-capped basket. After your other exceptions, you would have a hard-capped basket, and that basket could also be subject to a grower. And in addition to that hard-capped basket, you would have a ratio-based basket. So you'd have 2 ways by which you can make it. And then a third way by which you can make payments to equity is from what is called an available amount, or in other deals called a cumulative credit basket. So this basket is a multi-use basket in a TLB. From now on, I'm going to call it the cumulative credit basket. So the cumulative credit basket is a basket from which you can make restricted payments to equity, sub-debt payments, and permitted investments in a TLB. And the basket is composed, we've seen 3 different ways in which it can be composed. One, very much like a high yield bond, you have 50% of CNI, but you also have a hard capped amount, which is an out of the box amount that you get regardless, plus 50% of CNI. And then you have increments that are similar to high yield bonds, say proceeds from disposal of investments, dividends from unrestricted subsidiaries. Those help you to build up the basket. So that's one formulation. Another formulation is just based off of retained excess cash flow. In some deals, you have retained excess cash flow, and you also have a hard cap out of the box amount. But that's a rarely seen feature, but we have seen it before. And then the third way the cumulative credit basket can be composed is if you would have a hard capped amount, and you could have a hard capped amount plus the greater of 50% of CNI or retained excess cash flow. So this is another basket where you can make restricted payments to equity. So in some deals, you actually have those 3 together. You can make from your hard-capped RP basket, you can make from your ratio-based RP basket, and in addition, whatever is unused in your cumulative credit basket can be used to make payments to equity. And then secondly, you can make payments on subordinated debt. That is any debt within the structure that is subordinate to the SFA lenders. And usually what you see is you would have a separate hard cap basket. It has nothing to do with your equity basket. It's separate, so you can tap that for making sub-debt payments. And in addition, you can make sub-debt payments from whatever is unused in your cumulative credit basket. In some deals, you can have a ratio compliance test for the use of the cumulative credit basket, but a lot of other deals also do not have any testing. And in addition, certain deals allow you to make additional payments to sub-debt based on a ratio. So you could have 3 possible ways of making sub-debt in a TLB. We have seen some TLBs that are stricter, at the very strict end of the spectrum, where your ratio-based basket has to be funded from your cumulative credit amount, which is pretty much similar to the LMA style deals where your ratio-based basket has a specific source of funds. But in most of the deals, you could have these 3 separate avenues for making payments on sub-debt. And then in terms of value leakage, you have your investment basket or your restrictions on investment with your carve-outs. The investment is permitted investments in a TLB is the ability to make loans, the ability to make acquisitions, or general ability to invest in other things, say a JV. Generally, in your investment covenant, you would have a hard-capped basket. General investments, you can make it out of this basket. And then separately, in 33% of the deals we track in RLT, you have a ratio-based basket. So aside from your hard cap basket, you can go ahead and make if you are within a certain threshold. And then in respect of permitted acquisitions, you usually don't have a hard cap as you would have in an LMA deal. You just have the requirement to whoever the target is has to become a restricted subsidiary, so it has to be within your restricted group, governed by the provisions of the SFA. And some deals would require that target to become a guarantor, but not all deals. So where you have a deal where there is no guarantee requirement from the target, you would have a capped basket for making permitted investments in entities that do not then become loan guarantors. There would always be requirement that the assets be secured for the benefit of the lenders. But basically, the overview is in a TLB, there are so many ways in which value can leak out of the structure. So understanding how they all work together is very key to investors.